morning. I'm Carol Phillips, and I'm the author of the award-winning book, Transitions with Dignity. My goal is to equip and educate seniors and their families to empower them to plan and prepare for their future lifetime goals. As a senior real estate specialist, it is also my goal to protect the people I serve. I do this by bringing educational webinars to you and your families so that you can make the best decisions for your future. Last month, I featured Ron Adams, a leading estate attorney in the East Valley. He discussed trusts, wills, and probate, and what is the best choice for you. If you haven't watched it, I encourage you to go to transitionswithdignity.com, click on the webinars and watch it. I'm sure that you will learn something and it will empower you to make great decisions. This month, we're featuring Meredith Decker of Decker Financial, and she is going to discuss understanding the cost of senior living and financial planning. So we do need to learn about that. None of us want to live into we don't think about living into our 90s and 100s, but we might, and so we need to be prepared for that. Today, I'm going to introduce Meredith Decker of Decker Financial, and we're going to be discussing understanding the costs of senior living and financial planning. Now, Meredith has been a financial advisor in Greater Phoenix area since 2002. She's a chartered financial consultant and a certified divorce financial analyst. She founded Decker Financial Services, Decker Tax and Accounting, and Decker Divorce Financial Services. Meredith grew up in a small town in the Midwest and has an entrepreneurial background working within her parents' own businesses. She strives to build long-term relationships with her clients, and she works with the mindset of you harvest what you sow. She works with each of her clients to help them understand how that is applicable to their financial resource plans. She believes in the holistic process of financial planning and is a fiduciary following the guidelines of the Certified Financial Planner. Meredith also serves clients who are going through the divorce process and helps them determine what is fair and equitable division of assets. When a client knows what their consequences of their decisions are, many times they can keep out of court during and after the divorce process. She works side by side with her son and her husband. She enjoys quilting, photography, and spending time with grandchildren and then children.
Yes.
After this webinar, she invites you to a complimentary 30-minute phone or video consultation, and the information is on the slide before this presentation, and it will be after this presentation. So, Meredith, welcome. We're glad to be
Carol.
with you.
Yes, I'm excited.
Good. Well, our topic is understanding the cost of senior living and planning for that. And so my first question is, how are financial planning and senior living associated?
Well, it's a big topic. A lot of times it doesn't get addressed near early enough in a client's financial planning history. Most people understand what it means to talk about with retirement goals, how much money they can accumulate, when they can buy the big boat, when they can retire, all of those big things. But very seldom do people go beyond that to the point where they cannot travel or they cannot go out on the boat and water skiing anymore, or traveling like they used to be. And they don't think about those future things, about what it means if they have to have somebody come into the home and help them, or if they need to go to an assisted living or skilled nursing. But that is part of life, and it's something that we need to address sooner than later.
Okay, so why is it important to include your senior years in your financial plan?
Well, accumulating assets, you can understand that's that's one thing. That's accumulating is trying to get as much money, put as much money away, getting the greatest growth on that money. Distribution is retirement. So that's when you're using this money, using all of your hard-earned money to do these fun things. But then when it comes down to those 80 years of when you're 80s and 90s, sometimes older, people cannot necessarily do all of those things. So who wants to really think about that? Who wants to think about needing help with activities of daily living? What the heck is that anyway? It's whether they can feed themselves, whether they can take their medications, whether they can bathe themselves and get dressed. All of those things nobody really wants to think about. It's not on our goal board over here to have that big picture of what that is. So it is so important to do that. In our younger years, we set up those goals, we had those visions, maybe we wanted a second home or whatever, but nobody ever thought of that other place beyond that. And it's so important to start now. Yes.
The other place. I like that one.
Yeah.
Okay, so is there a time when it's the best time to begin thinking about senior living?
Well, a lot of times my clients will come to me when they're in their 60s, mid 60s, even later 60s, and they've gone through oftentimes with their own parents, going through a situation where they've had to put them in a skilled nursing facility or try to figure out assisted living for them or something. And that a lot of times is too late. That's a time where it's either you have all kinds of aches and pains that eliminate you from getting help or being able to get something to help you, or it's too cost prohibitive. And so we have to be very, very creative at times in that situation, many, many times.
Okay, so what's this progression look like?
So usually it starts with a client that is actually helping their own parents. That's kind of weird, but that's when it all of a sudden dawns on people like, I might need to have this help someday, or it struggles. You're in such your company is so beneficial to people because it gives them the ability to see what the consequences are of the decisions that they have to make and what are the choices. So rather than limiting your needs and your choices, this helps them get those medical decisions and those financial decisions made ahead of time. Another time is when their parents need financial assistance. So oftentimes as an advisor, we can see what's happening before the child sees it. If I have an older client coming in, oftentimes they'll want money for something, or they have all of a sudden built up credit card debt where they never had any before. There's weird things that begin to happen. And if we don't have it on file, who we can call to ask, hey, what's going on? The client itself is not a very good resource sometimes. We've had many times where clients all of a sudden took out a loan on their house to win the sweepstakes, to get a free car. They built up credit card debt, or they had a house. We had a case where the client had a house 100% paid for, and they were convinced to take out a reverse mortgage, and $500,000 went out of the country, never to be seen again, leaving this person really destitute. And especially then they needed help, but either a lot of times they're lonely. They want somebody to talk to, so they answer the phone. Sometimes they don't have children around that are checking on them all the time. Their personal finances are very, very important to an older person, and we need to respect that, but we also have to have them have a person that they trust, a trusted contact that we can go to and say, hey, we notice that something is not right here. We don't know what, but it's something that's not right. And you maybe haven't seen it because you haven't seen the accounts, or you haven't seen what's happening with the credit card debt, or they need to take extra money out to pay off this debt. often that happens. Yeah, it's very, it happens more and more, that's for sure.
I've been running into that as well. And so that's one of the reasons I'm so excited to be visiting with you and educating people about these things, because, and especially I think the adult child needs to start being aware if they're seeing something too, but they may not always see it first. So what are the considerations that need to be considered when you're planning for senior living?
So first of all, you have to have that vision. What do you want that to look like? Do you want to live with your children? Do you want somebody to come into your house? Do you want to live in a different facility? What is going to happen, and what do you want that to look like? A lot of times, if we can just have somebody come in our house, help sort the medicine, help us get dressed, we don't need to go into a facility. And maybe we can go into an assisted living facility where we get rid of that stereotypical of I'm locked in this prison and I'm on the caboose. And this is my last train ride.
That's been a challenge for a lot of people. I think that they picture it as when their grandparents lived in the nursing home and, you know, everyone drooled on themselves. You know, that was a pretty depressing thought. And it's not that way so much anymore. I've noticed that the communities that I go into are usually very well staffed and well run and kind of as cheerful as it can be. Right. And so that's kind of neat.
The other thing that they need to be really aware of is cost. What can they afford? What can they, you know, how are they going to pay for this? Because nothing is free in life. And even if you do go and live with a child, it's what are they giving up to take care of you? Maybe they've worked outside of the home. Maybe it's going to be extra costs even to live with a child because they have to take care of you. They have to run you places and their life becomes your caregiver. So what is that going to cost? Not only monetarily, but emotionally and relationship-wise to the family. And that's so, so important. And then you have to sit down and look at where are your existing funds coming from? What do you have for existing funds? Do you have a special savings account for this? Maybe you've dedicated one special investment that's just going to pay for this. Maybe you don't have, you have very few funds set aside for this. It's kind of a balance between their specific guidelines and questions that we are asked when we look at a client is like, how much can they afford? You know, as far as if they have to pay out of pocket, are there other resources available for them to pay for it? Or do they need some help with a long-term care policy or something like that? Maybe they have some type of supplemental insurance that they can utilize, but all of these things have to be looked at.
One of the things that I ran into too is sometimes, even though you want to stay in the home, you almost can't afford to stay in it because you still need the money to upgrade the bathrooms so that they have the grab bars or the walk-in shower or that kind of thing. Do you have the money to fix the air conditioner or get a new air conditioner? So sometimes those are limitations that need to be looked at. What are the resources the client might have access to?
So there's various ones. One would be possibly a HSA account, a health savings account. So right now, a lot of people have a chance when you're younger now to start thinking about that is you can have a high deductible medical insurance plan where you can put away a significant amount of dollars every year into that plan tax-free. When you retire, you can take that money out for medical expenses and long-term care expenses tax-free. Right now, today, it's the only tax-free dollars that we actually have. And so by utilizing an HSA and maximizing that, we encourage our clients to highly we highly recommend, if you can, and if you have it available to you, max it out. Do what you can, because, and maybe you're paying medical expenses out of pocket that year, but now this money gets a chance to grow and it actually can be invested. That's one way. Another way is possibly a reverse mortgage. So let's just say that you have a small mortgage on your current home, or you have it completely paid off. You can do what's called a reverse mortgage. A lot of times older people have a bad connotation about reverse mortgage, but they have changed. In the 1990s, they are no longer, that home is no longer owned by the bank, which is the way it used to be in a reverse mortgage. It is owned by you and will always remain in your name. And a reverse mortgage works exactly the way it sounds. It's a reverse mortgage. So instead of you getting the house paid free and clear at the back end, you're putting the mortgage on it and it's just continuing to grow. And at the end, after you have to be in living in the house, you can be out of it for 1 year. Either you have passed away or you're in a facility someplace else, but then you have to pay that mortgage back at that time by the sale, usually the sale of the house. So the sale of the house then pays off the mortgage, and then any remaining assets or equity that's been in that house goes to your beneficiaries, or it can go to pay for long-term care or something like that. So you can use it a couple different steps along the way, either by taking the money out on the front end to use to pay. And a lot of times people will do a reverse mortgage where they do it almost like a line of credit. So as they need it, they're pulling it out. Some people take it out as a lump sum. You can do it various ways, and there's different programs that the government has set up to do that. It's an excellent program. It's really, really good. My biggest challenge with that is trying to help people understand that they still own the home. That's the biggest challenge.
And one thing about still owning the home is, even though you're not making the payments anymore, that home is still, it's still going up in value.
Yes.
It's still appreciating. And I mean,
Yep.
it might go down, depending on the economy,
Right.
but most of the time it averages 4% a year. This year it's averaging 18% a year.
Yes. Yeah, and it's huge. And even if the market, the value of the house does go down, I had many clients that were in reverse mortgages before the drop in 2008, and many of those clients were called underwater. So the loan amount was greater than the value of that house. It worked out wonderfully. When they passed away, the beneficiaries, their children, took the keys, laid them on the desk at the bank, and they walked out. They were done. And it was so nice. I mean, even the kids said, if we wouldn't have had this, if mom and dad wouldn't have had this, they would have never had enough money to fund their facility that they lived in, and had a facility that was not state run. Right. And another way is Medicaid. That will pay a limited amount. Medicaid might cover some expenses in your home, but it's very limited. It's very limited. And Medicare will pay for your doctors, your hospitals, and that kind of thing, but it will not cover a long-term care or a skilled nursing facility. And then the last, okay, go ahead.
So you've talked about a long-term care insurance.
Yep.
Tell me about that one.
So long-term care insurance is something that you can buy today to supplement or to help pay for your long-term care needs. So as long as, usually the stipulations are, as long as you cannot do 2 of the 6 activities of daily living, such as dressing, feeding yourself, need help bathing, or something like that, as long as you cannot do 2 of those, you can go on claim. That does not mean that you have to go into an institution. It just means that you are now able to say, okay, I can use this policy now to help pay for somebody to come in my house and help me do these things so I don't fall, so I don't have to go into a skilled nursing facility. My opinion is it's the best thing, the best way to keep yourself out of skilled nursing is to have a long-term care policy so you can utilize these things at home. Sometimes you don't have another spouse there to help you. And even if you do have another spouse there, typically you're approximately the same age, and it may not be physically possible for that other person to help you do some of these things. Some of these policies will train a family member even to come into your home to do these things that they can be paid for this. Another benefit from it. Then it will also cover long-term or assisted living, and then skilled nursing, all of those different things. There's a multitude of different ones that we can talk about.
So what kinds of policies are available and what do they cover?
So typically a long-term care policy that it used to be a standalone policy only that was available. And this was just strictly for long-term care. In other words, strictly for just skilled nursing. Very few of the older policies had in-home help, but a lot of them now do. You can always have somebody to come into your home to help out. The long-term care policy, a true standalone policy is very limited today. It used to be that you could get pay in a 10 pay, you could pay up to the age of 65 and then stop paying. But a lot of those policies have gone away because the cost of long-term care has gone up so much. The other policy that's out there is a hybrid. That policy is typically a life insurance policy and a long-term care policy. In other words, your typical life insurance, you maybe have a $300,000 or $500,000 death benefit. Well, now what happens is you can either use this policy for either the death benefit or the long-term care. So you can have something you can choose. You can have it when you're living, or your beneficiaries can have it when they pass away. And this is so important because it keeps you from depleting the assets that you have. So let's just hypothetically say you had a $500,000 policy. Now you have $500,000 extra to use for your care.
So if you use it for your care, let's say you only use 200,000.
Right.
Does 300,000 carry over to the rest of the estate?
Yep, goes to the death benefit. Yes, if you've only used part of it. There's a variety of different ones out there. There are some policies. There's one company that offers a policy that is designed strictly for long-term care, where you put in, you pay for it over anywhere up to a 10-year period of time. You could do 1 time, 5, 10 period of time. And any time along the way, you either can get all of your money back with a small interest, or you can utilize the long-term care, or you can have the death benefit. So there's a variety of different ones out there. The one thing about a long-term care policy is in Arizona specifically, and more states are utilizing this, is they have what's called the partnership program. So let's hypothetically say I had no money and I was going to go into a long-term care or a skilled nursing facility. If I didn't have any money, I would have to go on Medi-Cal or Medicaid or something like that from your state, where they supplement and pay the facility for your care. Typically, they do not do that for in-home care. That is only for a facility, a skilled nursing facility. So you are going to, first of all, have to find a facility that takes Medicare and will take that client on to care for them. And they usually get the basic care. You, however, have to have depleted all of your assets. In Arizona, it's down to $3,000 in your accounts. That's it. If there is a spouse, they may keep the house, but if there is not, they have to sell the house Any assets have to be sold before and depleted before they can kick that in. With a long-term care policy, if you have a, let's just say a $500,000 policy, then you only have to deplete your assets down because of the partnership program down to 500,000, and then you can get state aid, and then thereby supplementing your care with additional funds that you now are able to have, plus you have had the long-term care that has played a part in this. And this is especially important for people with Alzheimer's or memory diseases, because their bodies are oftentimes very healthy. It's their mind. And they oftentimes need care a lot longer than somebody whose body is failing.
Right. Right. Okay, let's see. I'm looking to see where I am on this.
One of the things too about a long-term care policy is it protects your legacy. It protects your assets. So one of the questions that we often get is they'll say, well, can't I just give all my assets to my kids and then I won't have any money and then I can go on state care? Well, first of all, nobody wants to be on state care because the care is not the same quality as if you're paying for it. That's number one. Number two is if there's a look back period, a 5-year look back. So if you decided that you needed to go into a facility in 6 years, you could do that. But who knows that? And if it's in 5 years, the state has every right to go back and say, okay, where did this money go to? And they will go to the people that received this money and they will take it back.
Wow.
Yes.
Okay, so when's the time to buy a policy?
Typically, the sweet spot is between 45 and 50. A lot of times we don't have near the ailments, at that age yet. We haven't had the little breaks and the aches and the pains like often can come up. And so that's usually a very good time to be buying a policy because your costs are so minimal. They're very, very cheap. The older you get, the more expensive it is. So it's just the opposite. It works just the opposite of life insurance. With life insurance, they expect you, they're taking a gamble on you, and your life expectancy, the shorter it is, basically the cheaper it is, or the more expensive it is because they're going to have to pay out that policy. In a long-term care is they typically don't want you to live so long because the odds of them paying out are a lot higher. So they work in contrast to each other, but it is very, very important to get it when you're younger. The sooner, the better. Most policies, especially with this past year with COVID, they dropped the ages that they were issuing policies down to age 70. Now they have, I just noticed last week, they were upping the ages back up to 72 in that time frame, but you need to do it before you're 60, really, if possible.
So what additional issues should I consider for my aging parents?
So for your aging parents, there's all kinds of things. Do they need assistance paying their bills? One of the things that I really like to encourage my clients, my older clients, well, my 60 and over clients, I'll call it that way, my younger 60 and older clients, I like to have them bring in that trusted person that they want us to deal with in the event something goes wrong. Many times it's a child or something like that, but not always. Sometimes parents they love their children, but for some reason or other, something has happened. Their children aren't good with money, or they're just not sure of the situation. And trust is an issue. So I need to know, as a financial advisor, I need to know who that trusted person is that I can talk to. That's number one. The next thing is help them with their bills. Don't take it over, but help them. sit down with them and say, where are your bills? Where are your important documents? Where are your passwords? and if it was like my mom had 3 different books with little scribbles and scratches of all different passwords to all different accounts, and it was a nightmare trying to figure it out. My mother has passed away in 2017, and we're still trying to get rid of one of her stupid Facebook accounts. And because we can't get the password, we don't know what it is. And she had multiple accounts that she had set up. Oh, and those seem like little things, but believe me, you can be hacked. You have your identity stolen even after you pass away, and people don't even think about that. It's so important to make sure those things are protected. The weird thing is, run a credit report on yourself, because make sure that nobody has hacked into your Social Security number. You're maybe not even filing your parents maybe aren't even filing their taxes because they don't make enough. Those are the people that a lot of times their numbers get stolen, and nobody knows it because there's nobody they're not going to apply for credit. They're not going to buy a house. They're not going to file a tax return. So who's going to ever find out about it? So it's very important.
So on our website, Transitions with Dignity, one of the resources we have is a page for either the senior or the adult child to go through, and it lists all the different types of accounts that a person might have, including veterans benefits and all of these things.
Yes.
And so if you go there and print it out and work through that with your senior person, or in my case, we've got it together for my daughter,
right.
Make sure she's got all of this put together, because there are hidden accounts everywhere. And,
yes.
And especially in the silent generation, you find money and things in different places that you would have never thought to look.
Right, right. And they maybe have CDs somewhere, and they usually have them spread out in multiple banks. So one of the advice that I often tell my clients is simplify your life. Get your assets together in 1 or 2 locations. Put it, your investments with one advisor, put your banking in one account. And because so often especially if they've grown up during the Depression, they are so afraid of that bank closing, and so they have these accounts spread all over. One other thing too is oftentimes in different places. So I'll give you, it's a retirement community that my mom moved into in California. And they told all of the residents when they bought their condos to have one of their children's names put on the title with them. That is a huge mistake because it can make huge tax consequences to the child and later on. And it can also be a liability to that person. And that is really something that the reason that they want it, because they don't want anybody to die and then that place stand empty. They want to get rid of it. They want it to move. And so if they have nobody to contact, then this way it guarantees them somebody to contact. So they want to have it on there. They don't really care about all the consequences and the problems that it can cause.
Well, we kind of learned last month that those properties need to be either in the trust or listed with their name for the benefit of that
yes,
trust.
Absolutely. Absolutely.
So there are situations we should be aware of when caring for our parents. And I know that, you talked about identity theft and financial fraud and some scams. Does locking your account or locking your line of credit or locking their line of credit help prevent that kind of a thing?
It can. It can help somewhat. It's a process. A lot of times there is fraud that the client may be taking money out of a line of credit or their investment account or that kind of thing. As a financial advisor, I can't tell them you may not have your money, even though I know it's being used for fraudulent purposes. Any institution, a bank or like a TD Ameritrade or whatever that company is that is holding your money, does not have permission to stop you from distributing that money unless there is a power of attorney that they will accept that says, okay, there's fraud on this account. Do not let anything out of the ordinary happen. And you can put those on. Those are very difficult to get. A lot of times people will say, well, I do have power of attorney and I'm going to close my parents' accounts or I'm going to close this credit card. The banks will not allow you to do that because they have no proof that this person has a mental incapacity to determine what is fraud and what is not. Then you either have to go to court and get custodianship of that person by court order, or you have to have a doctor's written note saying this person is incapable of taking care of their finances. A lot of people do not want to do that. And I will tell you that is very, very difficult in Texas. It is just about impossible to get that done in Texas.
But we learned also in our trust, a possible workaround with that is to have a time when you are determined to be incapacitated.
Yes.
And have 3 people that you trust, 2 of the 3, and one of them should be the spouse, agree to that.
Yes.
But then you probably still have to have a doctor there. Okay, so how can we protect our aging parents' estate?
So first of all, making sure that they have that trust in place or a will. I prefer a trust, but especially nowadays, and you talked about this with Ron, and his points were excellent. I think the one thing is that you need to make sure that a trusted person is, that you give the name of a trusted person to your advisor. And that's very key. Because we can consult, we can give them a heads up if we suspect something. Let them know where all these documents are. Let them know what needs to be done. Let your financial person aware of who they can contact. That is so important. And also be prepared with what are the estate taxes? What are those things going to be? Right now, they're pretty high. An estate tax is very high right now. For a couple, you get an exclusion. However, in Congress right now, they are thinking about lowering the estate tax significantly, which means that you will be paying at about federal rates about 49%. And in certain states, not Arizona, but like Washington, where they have no property tax, they have a huge estate tax. So they have a 50% estate tax. Make sure that if you have properties in multiple states that you have taken care of that, because that can be an issue. For instance, the state of Washington will declare that all property that you have in their state is susceptible and is included in the estate taxes. So that's very, very important to make sure that you're constantly working with your financial advisor and looking at the tax consequences and their attorney, coordinating with them. My favorite thing to do is to be on the phone with my clients' attorneys and work through their state. That is like, it makes me so happy. It's weird. It makes me happy because I know that they're going to be taken care of when that time comes and that we've covered all their bases for them. And that is one of the things that I just absolutely love. Getting those power of attorneys and that type of thing is important. The other thing is weird little things. Who's going to pay for those day-to-day things like false teeth, hearing aids, and they're 90 years old and they lost their set of false teeth, or they lost their hearing aids and they're 90, 98, not in that great a health. Who's going to pay for that? If mom and dad don't have enough money to pay for it, are the kids going to pay for it? The kids don't pay for it. Are you're just going to let them go deaf or not eat? It's just one of those things. Have those decisions and those conversations, not only with your parent, but with your siblings. Like, okay, let's set up a fund. Let's do some proactive things here that if mom or dad need this, that we can just pay for that out of that fund. Be proactive about that. And I think communication is so important between the kids, the parents, and the financial advisor, and all of those things. Don't try to hide from your children what, unless that you really don't trust them. Then you need to get a fiduciary or somebody like that can handle that estate, and somebody that you do trust. If there is absolutely no one, then I would say that as a last resort, you hire a fiduciary. I typically would not recommend doing that as a bank. I would recommend outsourcing that. There are companies out there where you actually hire that person. It's a trusted person. They've been checked. They're not going to steal from you. They're going to look out for your best interest. That's what a fiduciary means. They're looking out for your best interest. So I would highly recommend that would be another way of just preserving what you have and making sure those bases are covered.
I've actually run into that a few times now, which kind of surprised me how many times that families they really don't want to take care of grandma,
Yep.
They just really want grandma's money. And that always disturbs me from a moral compass. But I have recommended people find a fiduciary and just to protect them as they get older, and remind the seniors that that's their money first. And it's for their use first, and then everybody else can have their piece of the pie however they want to deliver it out. The senior wants to deliver it out. So
one of the things that I'm always concerned about is when you do have your children that are helping this older person and that type of thing. There are times where I get really bad vibes, like, okay, is your motivation for this because you want to make sure that there's money for you in the end, or is this a good logical reason? And that's a hard call to make as a financial advisor, and that's why it's so important for me to know my clients and know what they want.
Right. So before we take questions from our listeners, which we are going to do in just a minute, are there any takeaways that you want our listeners to use today?
I think one of the big ones is that they need to sit down with their parents and have those difficult discussions. It is not a fun discussion necessarily, but do it sooner than later. And the reason I say that is because sometimes the older person will get very skeptical of why you're having this conversation with them now. And they get to mistrust people, even their own children, who are asking them only for their benefit and mean well, but they're not sure. So it's just like sitting down with the birds and the bees. Now you're sitting down and you're talking to your parents about their finances, and have that conversation. Go with them to their financial advisor. Make sure that you meet them and that your financial advisor meets their children, because that is a trusted person that financial advisor needs to know. And they need to have those difficult discussions in that same room with their advisors, and maybe even asking those hard questions that the parent or the child does not feel comfortable asking. And then think about your own future. How do you want that to look? How do you want to prepare for that? Now is the time to be thinking about it. We don't necessarily want to have a skilled nursing facility picture up on our vision board, but now is the time to be thinking about it.
Okay. And then before I go to questions, I'm going to tell everybody that Meredith's new book is called Financially Single, and it's advice for the divorced or widowed person. And there you go. And I think that that's going to be a really good resource for both those situations. Yes. And I know so many times one of the spouses are widowed, and it just changes your whole life on how things are. Yes. So now I'd like to open this up, and Rick, how do you want people to do that? Do you want them to just unmute themselves and ask? Yeah. Jason, he raised his hand. So Jason, you want to unmute yourself?
Hello.
Hey, Jason.
Nice to talk to you, Mrs. Decker.
Yes.
along the lines of what you were saying, the last thing you were saying, how have you run into like any of this predatory guardianship mess that's going on? I know there's a movie that just came out. I'm sure that it surprised a lot of people, but it's kind of been on my radar for a long time. And I'm curious if you've run into people like this and what a child can do to protect their parents from people like this.
I think I know the movie you're talking about, and I did see that. It was very disturbing. It was actually a company, if it's the same movie I was thinking about, a company that made sure that they came in and they basically stole the people's assets, even though they didn't need help. They were instigated, they were in groups. It was almost like a pack of wolves that would come down on these people. I think one of the biggest ways for your children, for you as a child to protect your parent from that is to have that conversation. Because when you have that conversation, you're going to know real quick how they are thinking about things financially, and you're going to know so that you can step in the event something like that would happen. And if there are no children, if there isn't somebody that you trust, then make sure that you are going through a vetted fiduciary company. And I would get recommendations, I would get referrals, I would do your research to do that and have that lined up ahead of time before it's too late.
Good question, Jason. Does
Excellent.
anybody else have another question?
I have a couple of questions.
Hi,
Sure,
Dee.
Dee.
Hi. On the long-term care. I've
Yes.
had it for a long, long time. I got it through Metropolitan Life years ago, and of course, then they stopped selling it. And one of the things that has happened on it is they will either increase your premium or they'll reduce the amount of your per diem.
Yes.
On your claim.
Excellent point.
Yeah.
And that is one of the downfalls of a straight up, long-term care policy. That's why right now I am a huge fan of the hybrid policies because they cannot reduce your benefit and they cannot raise the premium.
Okay. Well, Susie Orman, as you know, she says this is the best thing in the world you can do is have long-term care.
Yep.
Now, when you were talking about how you qualify on the disability,
Yes.
you mentioned a couple of things. Say, for example, that you do go into a facility. Is the amount that you receive from the long-term care exactly the same as if you stayed in your home?
It depends. And it depends on what kind of policy you have. There's reimbursement policies that will just reimburse you for the exact expenses, or there are other policies where you're not reimbursed, but you're just given a set dollar amount per month. So it depends on the policy that you have received. Typically, just a true standalone long-term care policy will just be a reimbursement policy for your expenses that you have had up to a certain dollar amount that month. So let's just say your benefit was $4,000 a month and you only were billed $3,000, then you're only going to get $3,000. Or if you were billed $5,000, you're only going to get $4,000. But the reason they limit that is because there's a cap on the whole amount of the policy. So if you have a cap of $500,000, then you're going to get paid for that period of time. If you get paid a specific dollar amount per month, that policy will typically run out faster than if you have a reimbursement policy.
The other thing is you mentioned about disability. I know that that you go into a facility, do you have to be, you mentioned something about, say you're still able to dress yourself, but you can't drive and you can't do a couple of things. Once you go into that facility, do you have to meet, what requirements do you have to meet for them to pay the facility?
Right. There are 6 activities of daily living that are standardly laid out by the government. Those are typically things like you can't feed yourself, you can't dress, you can't go to the toilet yourself, different things like that. There's 6 of them. If you cannot do 2 of those, then that's when you can go, it's called going on claim. And I will give you a hint. If there is a situation where you are getting closer and closer to that, where you cannot, do that, but you're still struggling, do not hesitate to go on claim if there are 2 of those things that a doctor will sign off and say you cannot do. Because most of the time, a long-term care policy to go into a facility will have an elimination period. Typically, it's about 90 days. So if you wait with going on claim until just before you go into the facility, then you're going to still have to wait that 90 days. So make sure that you go on claim right away so that the clock starts ticking.
Okay, I'm sorry to monopolize this, but I do have one more
Okay.
question about reverse mortgages, because
Sure.
I had heard some good things. Like you said, I think they're better than they used to be. And I've also heard that, there may be better choices for you than reverse mortgage. But on reverse mortgage, on the repayment that you do, and say it falls on on a child to do the repayment. I understood that your age had a lot to do with that, and the older you were, the less amount of the payment back to the government was. Is that true?
No. So typically what happens is the age comes in when you're taking the reverse mortgage out. So if you take out a reverse mortgage and you're 62, or if you take out a reverse mortgage when you're 82, you're going to get a lot more money out of that house at the age of 82 than you will at 62, just because of statistically you're going to live a shorter period of time when you're 82 years old versus 62. Paying the mortgage back is only a requirement of selling the house, and then the proceeds go back to the government or to the bank. That gets paid just like a normal mortgage would be paid off when you sell your house. And then any remaining assets go to the beneficiaries or to you if you're still alive in a facility. So if there's no assets left, then you just walk away. That's why you pay you have this guaranteed mortgage. And that's one of the things that why they avoid them, is they feel they're too expensive because they're paying a premium for that guarantee on the front end. But it's the best thing out there ever, especially if the market is down when you need to sell that house.
Okay, thank you very much.
I hope that helped.
Okay, so does anyone else have any other questions that they'd like to ask? I think that about wraps it up, Meredith. I just
All
want to
right.
thank you so much. And the information you gave us was so valuable and educated so many people. For those that haven't been online, it's going to be available on my website at transitionswithdignity.com. Next month, we are going to be talking with a group of 3 people about the variety of communities you can choose, and then how do you choose? What's the best choice for you or for your loved one? So Meredith, we'll see you later.
Excellent.
We'll see you later, and have
Thank
a great
you, Carol.
week.
Thank you, everybody. Bye-bye.
Bye-bye.